Hi, I'm Max, and today I'm going to show you how you can make $4,000 a month from your investments without selling any of your assets. Imagine making money every month without having to do much. Today, I'm going to share how you can do that. If you've never heard of these investment methods before, don't worry. I'll explain everything in a simple way. First, let me ask you, would you like to make money every month from the money you've already invested? You've probably heard of receiving money from investments, but today I'll show you how to make even more from it. Normally, you might get about 2 to 3% of your money each year, but with these methods, you could get 8%, 12%, or even 32% in some cases. Let's start with the basics. These methods work by owning shares in big companies, and then you allow others to buy the right to those shares for a certain amount of time. For example, let's say you own stock in Apple. You sell someone the right to buy those shares, and in exchange, you get paid. It's pretty simple, right? You own something, but you don't have to sell it. Instead, you let someone else use the right to buy it, and you get paid for that. So, which are the best methods for 2026? Let's look at some great options that can help you make money from the investments you already have. The first option I want to talk about is JEPI, which is a safer choice and focuses on the biggest companies in the market. With JEPI, if you invest $50,000, you can earn $341 per month. While that may not be huge, it's enough to cover things like rent or groceries. Over time, those small amounts really add up. In 10 years, you could earn around $4,900 just from the money you've already invested. JEPI is a great choice if you want something safe and steady. Next, let's talk about GPQ, which focuses on technology companies and gives you a higher return than JEPI. With GPQ, you'll get a return of 11.41%, which means for $50,000, you'll earn $475 per month. GPQ invests in major tech companies like Apple, Microsoft, and Tesla, companies that are likely to grow. In 2024, GPQ returned an incredible 24.89%. So it's not just about income, but also about growing your money. If you believe in the long-term growth of tech companies, GPQ could be a great option for you. Now, let's look at QYLD, which has higher returns but comes with a bit more risk. QYLD invests in a basket of tech companies and sells the right to buy these stocks every month. QYLD offers a return of 11.8%, meaning $50,000 will earn you $491 per month. QYLD has been paying steady monthly income for over 12 years, even during market ups and downs. It's perfect for people who want regular income without worrying too much about how the market is doing. However, if you're looking for the value of your shares to grow quickly, QYLD may not be the best choice. Next is XYLD, which is similar to QYLD but more diverse, including companies from all sectors of the market. XYLD offers the highest return on this list, 12.75%, meaning $530 per month for every $50,000 invested. This option gives you exposure to companies across different industries like tech, healthcare, and finance. But XYLD has one catch. It pays out more than it earns, around 346% of what it makes. For some people, that's okay, especially if you're drawing from your money for income, but for others, it could reduce the value of their investment. Finally, let's talk about TSLY, a high-risk option that focuses on Tesla and offers a return of nearly 100%. If you invest $50,000 in TSLY, you'll earn $4,163 per month, meaning you'd get your entire investment back in about a year. However, TSLY has a major downside. It has dropped 64% in value since it started in 2022. This shows that while the return is high, you need to be aware of the risks and the potential for significant losses. If you invest in TSLY, make sure you understand the risks and are okay with large price swings. TSLY is a great choice for aggressive investors who want big returns, but are comfortable with the risks involved. Now, let's talk about something very important you need to understand when investing in these funds: return of capital. Return of capital means you're not really earning money from your investments. You're just getting back the money you originally invested. For example, QYLD offers a return of 11.8%, but it only makes 0.10% from the actual investments. This means most of the money you get is your own money being returned to you, not earnings from the investments. So, is this a problem? Not if you're looking for regular income, but if you want to grow your money, it could be a concern. If you're young and want to build wealth, you may want to stick with a more traditional stock index. But if you're close to retirement or already retired and need monthly income, these options could work really well for you. The key is to understand your goal. Are you looking to grow your wealth, or are you trying to get income from the money you already have? If you want regular income, these methods are great, but make sure you're comfortable with the risks involved. Just remember, don't put all your money into one fund. It's better to spread it across a few options. The smart investors know that their goal is to create income, not to chase huge profits. So make sure to balance your investments wisely to get the best of both worlds. If you do it right, these funds can give you exactly what you're looking for, a steady income without selling off your assets. So now that we've covered the basics, let's look at the math behind these strategies. If you invested $50,000 in JEPI, you'd earn $341 per month. That adds up to $4,090 per year. But over 10 years, that could turn into $40,900 without you needing to sell anything. That's not a huge amount, but it can make a real difference to your monthly expenses, like paying off bills or saving for a trip. Now let's compare GPQ, which focuses more on tech companies. You'll earn $475 a month from your $50,000. Over 10 years, GPQ could earn you $7,500, giving you a higher return than JEPI. The best part? It also gives you exposure to some of the world's biggest tech companies like Apple, Microsoft, and Tesla. If you're comfortable with more risk and want to target companies with a lot of growth potential, GPQ is a great choice. For those who like more stability, JEPI is the safer bet, but it still offers good returns. Let's move on to QYLD, which gives you $491 a month from a $50,000 investment. That's about $5,900 a year, and it has been paying steady dividends for over 12 years. It's a fantastic option for people who want reliable monthly income without worrying too much about market swings. However, remember, QYLD isn't about growth. If you want to see your shares grow in value, it may not be for you. XYLD takes a different approach by investing in the S&P 500, giving you exposure to 500 major companies. With XYLD, you'll get $530 per month from your $50,000, which is $6,270 per year. This is a highly diversified option, so you're not just investing in tech. You're getting exposure to every major sector of the economy. It's a good choice if you want a balance of income and a little more diversity in your portfolio. However, XYLD pays out more than it earns, so it's important to be cautious, especially if you're planning to grow your money long term. Let's talk about TSLY, the one everyone talks about. It offers nearly 100% return, which sounds too good to be true. If you put $50,000 in TSLY, you'll make $463 a month, which is more than enough for most people. However, there's a catch. TSLY has dropped 64% in value since its launch in 2022, so you're taking a big risk. This means that even though you're getting high monthly payments, the value of your investment could be going down. If you decide to invest in TSLY, make sure you understand that it's not a buy and hold type of investment. It's only suitable for aggressive investors who are okay with high risk and understand that things could go wrong. Now, let's move on to the next important concept: return of capital. What does that mean for you as an investor? In simple terms, return of capital means you're getting your own money back, not profits. For example, with QYLD, even though it says it gives you 11.8% return, only a small portion comes from actual profits. Most of the return you get is just your initial investment being given back to you over time. So you need to be aware that you're not really earning that much money. You're just getting your own money back. Does this mean you should avoid these funds? Not necessarily. If you need income, it's still a good option. But if you want to grow your wealth over time, this strategy might not be the best fit for you. If you're young and want to see your investments grow, you might be better off with more traditional stock market investments. But if you're nearing retirement or already retired, these funds can provide consistent, steady income. So the question is, are you looking to grow your wealth, or do you just need to turn your existing money into monthly income? If you need income from your existing investments, these funds can work great. But you need to understand the risks involved. A smart strategy is to not put all your money into one fund. Instead, spread your money across a few different options. The key to success with these funds is balance, using them to generate income while keeping some of your investments growing. It's important to know that these funds aren't about getting rich quickly. They're about creating stable, predictable income. If you're okay with slower growth in exchange for steady income, these options are perfect for you. And if you're planning for retirement, they can give you the peace of mind that comes with knowing you'll have consistent income. Now let's talk about how to make this strategy work for you. It's all about setting the right goals and managing risk. The first thing you need to do is understand how much income you need each month. Do you need to cover basic expenses, or are you looking to grow your wealth for the future? Once you know your goals, you can decide how much of your portfolio should be invested in these funds. A good rule of thumb is to invest 20–30% of your total portfolio in these funds to generate income. For higher risk options like TSLY, keep them to 5% or less of your portfolio so you can enjoy the high returns without risking too much. Diversifying across a few different funds is the key to making this strategy work. Don't put all your eggs in one basket. The investors who do the best with these funds are the ones who understand their purpose: creating regular income, not chasing huge profits. If you use these funds wisely, they can give you exactly what you need: steady income without selling your investments. So, whether you're looking for extra cash for everyday expenses or you want to supplement your retirement, these funds are a great way to go. Now that you know how to use these funds, go ahead and start planning your investment strategy. It's never too late to begin. Now that we've covered the basics, let's talk about how to actually get started with these funds. The first step is to decide how much money you're comfortable investing. This will depend on your personal goals and risk tolerance. If you're just starting out, it's a good idea to start small. You don't need to invest a huge amount to see results. Even investing $10,000 can give you a steady income, depending on the fund and how much it pays out. Once you've decided how much to invest, the next step is choosing the right fund for your needs. For example, if you want a safer investment with lower risk, JEPI might be a good choice. It focuses on big, well-established companies. On the other hand, if you're comfortable with more risk and want a higher income, QYLD or XYLD might be better options. The key is to align your investment choice with your goals. Are you looking for steady income, or are you willing to take on some risk for more potential rewards? Once you've chosen your fund, you'll want to keep track of your investment to make sure it's performing as expected. Most funds will provide you with updates on how they're performing, so you can monitor your earnings and see if adjustments are needed. Don't be discouraged if your earnings aren't huge right away. It takes time for your investment to grow and produce consistent income. Remember, these funds are designed for long-term stability, so don't expect to get rich overnight. But with patience and careful management, these funds can provide you with a reliable source of income for years to come. One thing to keep in mind is that you shouldn't rely solely on these funds for all of your income. While they can provide steady income, it's important to have a diversified portfolio that includes other types of investments. Diversification helps protect you from risk and ensures you have multiple sources of income in case one investment doesn't perform as expected. As you get more comfortable with these funds, you can consider increasing your investment or exploring additional funds. But always be sure to stick to your investment goals and avoid making rash decisions based on short-term market movements. Now, let's talk about how to manage the risks involved in these types of funds. Every investment carries some level of risk, and with these funds, the risk is usually tied to market conditions. When the stock market is volatile, the income from these funds might be lower than expected, or the value of the fund might drop. To manage this risk, consider adjusting your portfolio if you notice major market shifts, or if the fund is not performing as expected. For example, if you're in a high-risk fund like TSLY, it might be worth considering moving some of your money to a safer fund if the market becomes unpredictable. Another way to manage risk is by regularly reviewing your investment strategy and making sure it still fits with your goals and needs. Keep in mind that the best time to review your portfolio is when things aren't going perfectly. This is when adjustments are needed. Even if things are going well, it's important to keep an eye on the bigger picture and make sure you're on track to meet your financial goals. When it comes to risk, you don't want to be too aggressive with your investments, especially if you need the income right away. For example, if you're in retirement or near retirement, it's better to have a steady stream of income rather than chasing high-risk, high-reward opportunities. If you're younger and still building your wealth, you might be able to take on more risk and have more time to recover from market downturns. The key is balancing risk and reward to make sure your investments match your financial goals and timeline. Another important thing to remember is that these funds are designed for people who want a regular income stream, not for people looking for explosive growth. If you're someone who is looking to grow your wealth quickly, you might want to consider other types of investments like stocks or index funds. But if you want stability and predictable monthly income, these funds are a great option. And if you use them wisely, they can help you build a steady income stream without having to sell your investments. So, whether you're looking to supplement your current income or build wealth for the future, these funds can be an important part of your investment strategy. One last thing to keep in mind is that you should always do your own research before making any investment decisions. It's important to fully understand the risks and benefits of each fund and how they fit into your overall financial plan. If you're unsure about which fund to invest in, consider talking to a financial advisor who can help guide you in the right direction. They can provide valuable insight into which funds may be best suited to your goals, risk tolerance, and timeline. And don't forget, investing is a long-term strategy. It's about being patient and allowing your investments to grow over time. So take your time, stick to your plan, and stay focused on your financial goals. By doing this, you'll be on your way to building a steady income and achieving the financial freedom you've always wanted. Now that you know how these funds work and how to manage them, it's time to get started. Start small, stay patient, and over time you'll see the benefits of steady, passive income. And as always, make sure to keep learning and adjusting your strategy as needed. The more you learn, the better your decisions will be. Well, your investing can be simple, but it's all about making the right choices and staying consistent with your plan. So, if you're ready to take the next step in your investment journey, now is the perfect time to start. And don't forget, whether you're just starting out or you've been investing for years, it's always important to keep your goals in mind. If you found this video helpful, don't forget to hit like, leave a comment, and share it with others who might benefit. Thanks for watching, and I'll see you in the next video, where we'll talk more about how to build a $5,000 per month passive income portfolio. Now that you know the basics, let's talk about taking the next steps in investing. Start by deciding how much money you're comfortable investing based on your goals. If you're new, start small. You don't need to invest a lot to begin. Even with $10,000, you can still earn a steady income if you choose wisely. Once you're comfortable, you can start investing more over time as your confidence grows. Align your investment choices with your goals, steady income or higher risk and growth. Review your investment regularly to make sure it matches your changing needs. As you get closer to retirement, consider shifting to safer investments for more stability. For younger investors, taking on more risk might be okay to grow wealth over time. Flexibility is key. Adjust your investments as your financial situation changes. Know how much monthly income you need. Calculate your expenses to plan accordingly. Once you know your monthly needs, you can adjust your investments to match them. If you need more income, look into higher yielding funds that pay more monthly. Don't put all your money into one investment. Diversify to reduce risk. A balanced portfolio is safer and more effective for long-term income generation. Stay disciplined and avoid making emotional decisions based on short-term market movements. Don't check your investments too often, as it may cause unnecessary stress. Focus on long-term goals and don't get distracted by short-term changes in the market. Learn to ignore the noise from the media and focus on your own investment strategy. The more you understand your investments, the better decisions you'll make. Education is crucial. Keep learning and adjusting your strategy as needed. Stay focused on creating reliable income, not chasing huge profits. If you want steady income, these funds are a great option. Make sure you balance your income-focused investments with long-term growth strategies. Be patient with your investments, and they will provide reliable income over time. Setting a clear long-term plan is key to managing your investments effectively. Track your progress regularly, but don't obsess over small changes in value. Celebrate small successes along the way to stay motivated. The more consistent you are with your plan, the better the results will be. Stay calm and stick to your strategy, even when the market gets volatile. Avoid reacting impulsively to short-term market moves and stay focused on your plan. Tuning out the noise can help you make better investment decisions. Stay informed, but avoid getting overwhelmed by every financial news update. Always ask questions and seek advice when you're unsure about your investments. There's no one-size-fits-all strategy, so choose what works best for you. As you gain experience, you'll feel more confident in making investment decisions. The key to success is making informed decisions based on your goals and strategy. Take things one step at a time and stay disciplined in your approach. Remember, investing is about creating steady, predictable income over time. Always keep your financial goals in mind and stay patient as you work towards them. Start small, stay patient, and over time you'll see the benefits of passive income. Keep learning and adjusting your strategy to improve your chances of success. Investing doesn't have to be complicated, but it's important to stay consistent. Stick to your plan, focus on your goals, and you'll build a secure financial future. Whether you're looking for extra income or financial security, this strategy works. Don't forget to review your investments regularly and make adjustments as needed. With the right knowledge and strategy, anyone can make investing work for them. Keep learning and improving your strategy to ensure your success. I hope this video has helped you understand how to create steady income from your investments. Thanks for watching, and I'll see you in the next video where we dive deeper into building a $5,000 per month passive income portfolio.